Central banks have been net buyers of gold for 16 years in a row. Not 16 months, not 16 quarters, 16 consecutive years. That includes years when gold rallied, years when it fell, years of inflation, years of disinflation, years when the dollar was strong, years when it was weak, recession years, expansion years, through 3 different US presidents, through a global pandemic, through the largest war in Europe since the Second World War, and the rate has been accelerating. Annual central bank buying roughly doubled in 2022, from about 480 tons a year to over 1,000. The most recent World Gold Council survey reports that 43% of central banks plan to increase their gold holdings in the next year. That's the highest reading in the 8-year history of the survey. The question is, why? Why can't they stop? What does the data actually say about what they're hedging against, who is buying, and what they're planning to do next? Let's walk through it. Quick note before we dive in, nothing on this channel is financial advice. We're covering the data, the history, and the news. Everything you watch is for educational purposes only. With that said, here we go. To understand why central banks can't stop buying gold today, you have to know how much gold they used to hold, and how that changed. Before August 15, 1971, the day Richard Nixon closed the gold window and ended the dollar's convertibility to gold, gold made up approximately 70% of all global international reserves. That's not 70% of some niche bucket. 70% of total foreign currency reserves held by every central bank in the world. The international monetary system was fundamentally a gold system. Over the next 30 years, that share collapsed. By the year 2000, gold had fallen to roughly 10% of global central bank reserves. The US dollar, which had replaced gold as the world's primary reserve asset, peaked at 72% of foreign exchange reserves in 1999. For most of the 1990s, central banks were net sellers of gold. The narrative was that gold was a relic, a non-productive asset, something modern central banks should hold less of, not more. The most famous example of that thinking came from the United Kingdom, and we'll come back to that in detail. But it's the right setup for what happened next. 2010 is when the story changes. In the immediate aftermath of the global financial crisis, which had revealed just how fragile a financial system based entirely on counterparty trust could be, central banks in aggregate flipped from net sellers to net buyers of gold. That hasn't reversed since. The World Gold Council's data shows central banks have been net buyers every year for 16 years in a row. Not every single central bank. There are sellers each year. But on a global aggregate basis, the official sector has been adding gold continuously since 2010. The early years of that streak were modest, somewhere between 200 and 500 tons a year. Emerging market central banks, Russia, China, Turkey, India, Kazakhstan, led the buying. Western central banks by and large did neither. They held their existing gold reserves but didn't add aggressively. Then 2022 happened. On February 28, 2022, 4 days after Russia invaded Ukraine, the United States, the European Union, the United Kingdom, Canada, and Japan announced coordinated sanctions that froze approximately $300 billion in Russian central bank foreign exchange reserves. Approximately $300 billion, frozen, inaccessible, overnight. That action sent a signal every central bank in the world received clearly. Holding foreign currency reserves in dollar, euro, sterling, or yen-denominated assets carries a specific kind of counterparty risk that gold does not. Dollar reserves can be frozen. Euro reserves can be frozen. Gold sitting in your own national vault cannot. A peer-reviewed academic paper published in February 2026 confirmed what most market observers already saw in the data: a statistically significant structural break in central bank gold buying behavior at Q1 2022. Annual central bank gold purchases approximately doubled. Pre-2022, about 480 tons per year. 2022, 1,082 tons. 2023, 1,037. 2024, 1,045. 2025, 863 tons. The first quarter of 2026 came in at 244 tons, the highest single quarter since the end of 2024. That sustained buying pace, over 1,000 tons a year 4 years running, represents the largest accumulation of physical gold by central banks since the early 1970s. Since the gold window closed, the buyers are not random. In 2022, the single largest country buyer was Turkey, The Turkish central bank added 148 tons, its largest annual gold accumulation ever, pushing total reserves to 542 tons. The same year, Turkey was experiencing approximately 86% year-over-year inflation. Gold was for Turkey a domestic monetary anchor. China resumed disclosed gold buying in November 2022 and has now reported 18 consecutive months of monthly gold additions through April 2026. The People's Bank of China publishes its reserves with a deliberate lag. Most independent analysts believe the actual Chinese gold accumulation exceeds what is officially disclosed. Disclosed reserves: 2,313 tons as of the first quarter. Poland is the consistent named country anchor. Poland's central bank added 90 tons in 2024, making it the single largest buyer that year. In 2025, Poland added 102 tons, again the largest single country buyer. In the first quarter of 2026, Poland led again with approximately 20 to 30 tons. India added 33 tons in 2022 and has continued meaningful buying through 2025. Uzbekistan, Kazakhstan, Saudi Arabia, the United Arab Emirates, Singapore, the Czech Republic, and Hungary are all on the rotating list of active buyers. What's worth noting about that list? Every country on it shares specific characteristics. Either it has been sanctioned, or it is geographically positioned in a region where sanctions risk is a structural concern, or it has experienced inflation severe enough to test the credibility of its currency, or it is part of the BRICS Plus expansion that has been actively building non-dollar settlement infrastructure for the past 3 years. The buyers are not random. They share a profile. The World Gold Council publishes an annual survey of central bank reserve managers. The most recent edition, the 2025 Central Bank Gold Reserve Survey, polled 59 central banks. The top 4 stated reasons for holding gold by percentage of central banks citing each as important. Number 1, at 85%, was, quote, effective portfolio diversifier. Number 2, at 81%, long-term store of value or hedge against inflation. Number 3, at 80%, performance in times of crisis. Number 4, no default risk. But the more interesting number from the survey is the forward-looking one. 43% of the central banks surveyed indicated plans to increase their own gold holdings over the next year. That's up from 29% in 2024. It is the highest reading in the 8-year history of the survey. 95% of respondents expect global central bank gold reserves to rise over the next 12 months. None expect their own reserves to decrease. Translation: when you ask central bank reserve managers directly whether they plan to keep buying gold, an overwhelming majority say yes, and the share saying yes is rising every year. To understand why this is significant, you need the contrarian historical reference point. Between July 1999 and March 2002, the United Kingdom sold 395 tons of gold in 17 open auctions. The average sale price across those auctions was approximately $275 per ounce. The total raised, about $3.5 billion. The decision was made by Gordon Brown, then Chancellor of the Exchequer in the British government. The stated rationale was portfolio rebalancing, selling a non-yielding asset, gold, and reallocating into yield-bearing instruments, primarily euros, dollars, and yen. In retrospect, the timing was almost perfectly wrong. The sales took place near what is now called the brown bottom. The gold price at the time of the UK sales was the lowest it would be for the next quarter century. At today's spot price of approximately $4,694 per ounce, the same 395 tons of gold would be worth approximately $59 billion. The UK left roughly $55 billion on the table. The decision was reviewed by subsequent parliamentary inquiries. The Observer republished a retrospective on the sale on January 31, 2026. The contrarian lesson, for central bankers globally, is that the most rational-sounding decision to sell gold at the time can produce the largest documented loss in central bank history. Every central bank reserve manager today knows this story. No one wants to be the next brown bottom. That is part of why central banks can't easily stop buying gold even if the price feels high. The career and institutional risk of being early to sell is documented and severe. Step back from the country-by-country buying and look at the aggregate. The US dollar's share of global foreign exchange reserves, according to the International Monetary Fund's Currency Composition of Official Foreign Exchange Reserves database, also known as COFR, was 72% in the year 2000. As of 2024, it is 58%. 14 percentage points of decline in a quarter century. That share has gone primarily into other currencies: euro, yen, sterling, the Canadian dollar, the Australian dollar, and, increasingly, into gold. Gold as a share of total global central bank reserves was approximately 10% in 2000. As of 2025, that share has more than doubled, to approximately 27%. It is the highest gold share level since the early 1980s. Pre-Nixon shock, that number was over 70%. The 30-year decline from 70% to 10% took place between 1971 and the year 2000. The reversal, from 10% back toward higher levels, is now 15 years in. 27% is still well below pre-1971. The trend, however, is clear and accelerating. Two analysts who matter said specific things this week. Pierre Lassonde, founder of Franco-Nevada, Canadian Mining Hall of Fame inductee, one of the most respected mining finance veterans alive, told Kitco on May 12 that he expects gold to reach $17,250 per ounce within the next 3 years. The anchor of his forecast is the $40 trillion U.S. debt structure and what he describes as a, quote, 1970s replay. ING's commodity team, specifically Karsten Manthe, in research published the same week, forecasts gold reaching $5,000 per ounce by year-end 2026. ING's stated drivers, quote, central bank demand and improving ETF flows. Those forecasts are not from precious metals bull marketers. Lassonde runs a major mining company. ING is a global universal bank. Both are major institutional voices doing the same supply-demand math we just walked through. On August 15, 2026, 3 months from now, the world will mark 55 years since Richard Nixon closed the gold window. That anniversary doesn't trigger anything specifically, but it is the symbolic backdrop for the discussion that's already happening at central banks, at major banks, in academic monetary economics, and on financial Twitter. The data is what it is: 16 consecutive years of net buying, a documented structural break in 2022, 43% of central banks planning to add more next year. Gold's share of reserves climbing from 10% toward levels not seen in 40 years. The eternal question, why can't central banks just stop buying gold, has a documentable answer. They can't because they wouldn't stop with the situation they're hedging against. Sanctionable dollar reserves, $40 trillion debt structures, 3 decades of dollar share decline, inflation regimes too high to ignore, career risk of becoming the next brown bottom. When the next World Gold Council survey publishes, watch whether the 43% rises further. Watch the country-by-country tonnage. Watch Poland, Turkey, China, India. Watch whether the gold share of total reserves crosses 30% for the first time in 40 years. If you found this useful, subscribe and we'll keep tracking it. We cover the data, the history, and the macro stories almost nobody else is connecting. See you in the next one.